obviously, taxes is what quick was top of mind on everyone's mind in the end of August. And maybe they saw the little blurb I put out, but maybe you didn't. Recently, the Fraser Institute, I'm not sure who they are, but Fraser Institute, they a colleague of mine posted this, and I'm just kind of piggybacked on his post. Fraser Institute did their annual report, and they said the average household income in Canada is about $109,000 household income. So whether that be one or like a couple, the average household income is 109,000. And if we bundle in all of the taxes, income tax, federally, provincially, property taxes, some sales tax, just tax, dump it all in. Guess what? 43%. And Rob and I had a conversation a week ago, and Rob, I used it on the live today. And guess what? Perfect timing of doing this webinar on Wednesday means if you're showed up for your corporate job today, you actually are working for yourself today. Wait, what? What do you mean? Monday and Tuesday, you actually work for the tax man. 40% goes to taxes. So if 40% goes to taxes, becomes lower than you first started. Oh, that's not great. All right, let me. Can everyone else hear me? Okay. Paul, just let me know that the sound's kind of off a little bit. Um, if you're okay, Rob's giving me the thumbs up, so maybe it's just kind of the internet. But everyone good. Okay, always good. But I appreciate that, Paul, because sometimes I'd be like, people are like waving at me and they can't hear me. Okay, so 43% means that round down 40% means that Monday and Tuesday, Monday's 20%, Tuesday's 20. So 2020 equals 40. I know we're doing a bit of math today, but the first 2 days of the month represent 40% of the work week. And if you're paying taxes at 40%, that means Monday and Tuesday you just worked to pay taxes. How's that feel? Did you realize that? Is this common knowledge, or are we just kind of like, we know that generally what happens is like, depending on your pay or annual salary, kind of by May, June, July, August, you stop paying for like EI and CPP potentially. They kind of cap out at about 65,000. So depending on how fast you get to year to date income at 65,000, those stop. Income tax doesn't stop though. So anyway, that was quite shocking. I don't like how they spend my money. I know if we could just kind of tell Revenue Canada, like the government, about, hey, I'm okay paying taxes, but can I have a little bit of say as to where my dollars go? We're not getting into politics today. We're not going to get into like liberal versus like political party. That's a great way to just like cut off half the audience. So we're going to stay pretty neutral today. Um, I do believe, and I have some colleagues that are kind of like saying, hey, maybe it's time to kind of do a little overhaul on the whole tax act itself. Not sure we're not going into that today. So anyway, that's just that article is what triggered to say, Dwayne, one of the things that I did really well in the past, it worked really well, was doing these monthly webinars on, hey, how to pay less tax. And I realized I hadn't done one in probably like 8 months. So that kicked off to say, hey, let's do it in the end of August. We can start doing these and not have to wait till January when it's too late for some of these strategies. It's perfect timing, and you're probably doing a bunch of these things already. Yeah, it's a good question about just kind of wondering where our dollars go. Now, one thing, it's a bit funny. It's a but it's not on the 7 ways to pay less tax. Uh, it's a bonus. So since you're all here, I'm gonna share and you got here before the latecomers are probably gonna get here at 1 o'clock. But so there's actually an eighth way to pay less tax. And is it okay if I share the eighth way first before the first 7? Okay. So I actually voluntarily paid some tax the other day, and I'm curious as to how many other people use this as kind of their plan B for retirement. So a lot of people, like, you have a plan A for retirement, like an A plan for retirement. Could be put money in the RSPs, doing some things, company pensions. That's kind of the A plan. Building a business that you can sell, all A type things for retirement. So yeah, some people have RSPs, they have a plan. The plan is better than no plan, right? Like fail to plan, plan to fail. So I use it occasionally. I have a occasional, I'm not committed to it though. I have a plan B. And how to talk about there's 26 letters in the alphabet. There's like A, B, C. So I've moved to sometimes using plan two, which was it's the retirement plan sponsored by OLG. Is anyone familiar with the retirement plan funded by OLG? For those of us in Ontario, someone's smiling, Rob's smiling. Lottery tickets, beautiful. It was 70 million plus like 45 bonus millions. Like we have to be kind of like just a little bit of hope, right? We just need a little bit of hope. $6 for like one line plus encore, $6. That's a voluntary tax. I voluntarily gave the grocery store person $6 and they gave me a little piece of paper. I had hope, kind of prayed on it, sprayed some fancy, I sprayed a coral angel on it. And I said a meditation. I said, please. I just had random numbers. And then I checked the tickets the next day and I had like one number on each line. Now, fortunately, that money goes to like OLG funds different organizations, and that's run by the Ontario Lottery and Gaming Commission, but that's a voluntary tax. So point eight is like number 8 on the list is if you're spending, and now they do it twice a week. I did Lotto Max, right? It's Tuesday and Friday, plus like $6.49, and like some people, I won't say who, are paying like $20 or more a week on lottery. And that's your choice, right? That's your choice. But I'm just saying $20 a week times 50 weeks is $1,000. That's like an extra payment on your mortgage. That's a good weekend away on a vacation. So I actually started, it's over here on the shelf there. There's a jar. I'm not sure if you follow me on Facebook, but every Sunday I've been doing 52-week money challenge. So we started with $1, $2, $3. We just finished week 34. $34 went in the jar. By the end of the year, I'll have $1,350 some dollars in the jar. And it was practicing the saving habit. All right. So, all right. So that's the bonus number was number 8 was voluntary tax. Just stop buying lottery tickets. You're taxing yourself by buying a lottery ticket. Now you might win, right? So there's always that chance that you might win. But honestly, so me personally, as long as I still have like a mortgage and debt, my budget for lottery tickets is almost zero. I was thinking, and if you're all here, if you're interested, I was actually thinking about starting like an investment club. And we each put in like $1 and we just fund, like we buy like one lottery ticket for the group and we just split it. You have to do a formal structure. So if anyone's interested in joining the investment club, you can just type in the comments club and I'll follow up with you. And we can buy like a pooled ticket so that at least not all of our money, and we could do that. My aunt actually does this. Really quick side story. My aunt actually does this with her friend. So one of them puts the $5 into the bank account and one spends $5 on the lottery. And at the end of the year, they look to say like who has more money. And then they split the difference. So if anyone's interested in joining the lottery club, the investment club, then I'm serious. I am serious. You can just type in club. Yeah, a couple of people. Lynn's interested. I think it's like, hey, for like, not necessarily $5 a week, but for like a token amount, we just stretch that out over the year. All right, so that's an option. Okay, so let's get into the 7. Let me just grab my notes here, and these notes. Should I tell the secret, Rob? Paul, should I share my secret?
Yes, please, Dwayne. Please.
All right. So I know what they are, but I thought, hey, let's just do a little bit of research. Is anyone here like doing research? Like you're all here, so you're probably not big researchers, but anyone like researching themselves?
I don't know about liking research, Dwayne, but it's very important for a lot of projects.
Yeah, right. but part of it is when we do research specifically on the internet, we need to be aware of like how reliable is the feedback, like the content that we're getting. Like Wikipedia, like I have my two sons have recently like finished high school, and my sister's a teacher, and like a lot of kids just reference Wikipedia as a reliable source. Maybe, maybe not. So what I went to is I went to our favorite AI tool. I went to ChatGTP, and I typed in 7 ways for Canadians to pay less tax. So you could have done that. You could have typed that in, and you could have just read what I'm going to present to you, but it was far less entertaining. And you'd be like, is this real? Like, is this all like these are the only options we have available as Canadians? And you have to remember with AI and any research like that, it's only as accurate as like what's in the system, right? Like it's just, and you have to make sure like is it being verified by, is it referencing CRA? And just so you know, the big tax databases are not open to AI yet. So chat GPT and the AI tools, they can't actually get into like the hardcore tax databases. They can scour like internet like websites and other things and blogs, and they can gather information that way, but they can't actually get into like the hardcore tax sites where accountants go for entertainment. Okay, so number one, and someone actually did it. It wasn't lottery tickets. Someone actually commented. Christina actually commented. So Christina, you could win a prize. There are going to be prizes available. I have a couple things to give away today, so hang in there. Also good if you keep answering some questions because you might win a prize. I haven't said what the prize is yet, but Christina was on board and she said RSPs. So guess what? It's still whether you like RSPs or not, it's like the for the average Canadian, not saying that you're average, but just saying for the average Canadian, RSPs is still the number one way. It's not a tax savings, it's a tax deferral. So just everyone understand like what RSPs are. It's our registered retirement savings plan. You can do them through work. You can do them through your local bank. You can do them through your financial advisor. What happens is you put money in, and you get a tax refund based on your marginal tax rate. That's a little bit of accountant tax speak here. Based on your marginal tax rate, you'll get a refund. However, when you take that money out at a later date, you're going to pay tax at whatever your future marginal tax rate is. So here's a quick tip, and this is why like my clients love working with me. Maybe you do your own tax. We haven't done that survey yet. We'll do that in a bit. The advantage of working with an accountant is we just kind of educate you to say, generally, if you're earning less than like income wise, and if you're in the 50%, if in the 15% tax bracket, so if you're earning less than 50,000, if you're a student, I said don't put, and you're planning to earn more, don't use RSP room, because chances are in retirement, your retirement is going to be in a higher tax bracket, and you're actually going to pay more in tax when you take it out than when you put it in. So for some of my self-employed entrepreneurs have business expenses, blah, 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 they've reduced their taxes already. It doesn't make sense to use RSPs. When it does make sense is where I have like higher net worth clients who are making $150,000, $200,000 of taxable income, $250,000 of taxable income. You're in the 53% tax bracket. For every dollar you put in, you're going to get 53 cents back. And as long chances are in retirement, you're not going to be in the 53% tax bracket. So really quick, at a high level, it's not to educate you completely on RSPs, but RSPs is still kind of the number one way to defer taxes and potentially tax savings playing between the tax brackets. Okay, hopefully that's makes sense. And obviously, my job today is actually to have you have more questions than answers, so that you potentially, and I'll put up a link where you can book a complimentary call with me and kind of get a little bit more detailed. We're not going to have you solving all of your financial problems today. It's just to kind of be aware of, if you weren't aware of RSPs. And the main kicker for this one as well, if you're young or old, is if your employer is offering RSP matching, sign up for that right away. because that's free money where people are going to put in. Um, yeah, that's okay. Someone says, if you have to go, it's okay. I don't mind. Like I said, there's going to be a recording if you want. I'll send out the other tips. The key is if an employer is going to give you matching, that's free money. So always, always, always sign up for matching, and especially if you have pension money, pension options as well. It's really important to get that going. I still remember when my first job out of university, I was maxing out my RSPs really early because the company was offering 3% matching, and I didn't have any expenses, and just socked a bunch of money away really early. So that's number one. Number two is actually the other accounts. So again, if you're sitting with money in a bank account, if you're just sitting with money in a checking account, at a certain amount, they're going to issue you a T5 or a T3, most like a T3 for interest income. You're just creating more taxable income. This is more for my clients who are retired, who are seniors, and they're sitting with like balances in like open accounts, and they're triggering interest income, which is 100% taxable, but they have TFSA room. Your TFSA is your tax-free savings account room. And specifically for younger people as well, when I said, hey, while you're earning money to get to that point where it makes sense to put money into your RSP, start by putting money into your tax-free savings account, because even though there's no tax refund on the way in, the growth is tax-free. Now it's amazing, Rob. Paul, you guys probably saw these articles too. Recently, there was a guy that had so the average, if you're my age, you know, anyone over the age of 40, you have about close to $90,000 of TFSA room. Someone actually grew that to $1.5 million. Yeah, how did they do that? And it took a bit of hit the other day because he had Tesla stocks in there. So again, some people have made some really wise investment decisions, and they're not day traders. They just made some really good investment decisions over, say, the last 10 years, and they've really been able to grow that money. So TFSA is the idea is to not trigger more taxable income. You don't need more interest income taxed at 100%. So leveraging the tax-free savings account. Now, I'll lump kind of like that's number two. I'll lump another one in with number two, which is the RESP, which is the Registered Education Savings Program. So this is more if you're on the other end, kind of like where my ex-father-in-law is. If you're retired and you have pension income and you have some money sitting in the bank again, and now you've maxed out your TFSA and you're over 70, so you can't put any more money into your RSP, and your tax-free savings account is full, gifting to your grandchildren or your nieces and nephews is a great solution. Don't gift all your money, but gift some. And then if you're a little bit worried about how they're going to spend it, if you put it into their RESP, the nice thing is it now grows tax-free for them, the income and the government grant at 20%. So you get an automatic 20% return on your investment for them. The government grant and the growth becomes taxable to them in the future, not to you. And that money, chances are that money is going to go over to them anyway on your death. And you're avoiding a great way to avoid probate tax too, because if stuff has to flush through your will, you're going to pay probate tax on that. So having a strategy where anywhere from like, I don't know, $1,000 to $5,000 a year you could gift to your grandchildren and have it grow tax efficiently for them is another way of how to pay less tax for you. Because if it's sitting in just a regular savings account, not tax protected, you're triggering more taxable income for you, and that most cases that's the last thing you need. Okay, so that's kind of lumped into the tax-free savings account, and say, hey, if I already maxed that out, how then you could also implement this 2.2 option B, which is the tax education savings plan. And we actually did that with my ex-father-in-law because he was going to gift some money to my sons for education anyway. So we said, hey, my youngest son wasn't 18 yet, so literally in April, he gave us some money. We dumped that money into the RESP, automatic 20% return, and he could literally start pulling it out this year. He got 20% return in less than a year. That's pretty good. Where else can you get a 20% return in less than 12 months? Drop money into your children's or into your grandchildren's RESP. Just that's a pretty good option. Okay, so that's number 2. Number 3 is available credits. Okay, what do you mean? Well, it's common. I was just doing a tax return for actually a final estate tax return. And what we realized, and I'm kind of looking back at the previous accountants' files, and I'm not sure if they did it or not. So available credits is things like rent. So if you're paying rent and your income's below 50,000, um, more so maybe in retirement, but at a certain point, if you're paying rent, or if it's your parents and they're in a nursing home, that fee for the nursing home, you can count it twice. You can count it under the Trillium benefit, where you get a monthly credit, money in your bank account, as well as if it's a nursing home, the tax receipt will include this amount, which can be included as a medical expense, also a tax credit. So it's really important to understand what credits are available. Another example is pension income. So if you're in your 60s and maybe not quite 65 yet, and you're not pulling a pension yet, one thing you can do is you can actually transfer a little bit of your RSP into a RIF. Draw that, because that will actually trigger, there's actually a $2,000 a year pension income credit, but it's only triggered when you have pension income. So again, those are things in kind of like in that 60 to 70 age bracket, those things are available. The other thing is just medical expenses. Pooling the medical expenses for the family, for like a husband and wife, pool them together, and then making sure that the medical expenses goes on the lower income earners tax return, because their minimum amount will be lower. So there's a whole laundry list, and even just if we get into credits, is that eligible medical expense medical credits, right? Like what is an eligible medical? It's the obvious ones. It's like dental and optometrist and some other, but there's a whole bunch of other credits available, and it just depends on, like, do you qualify? Super important. The other, so if again, tax credits, the disability tax credit, no, so now type 1 diabetics are automatic. Yeah, Rob's. So before it wasn't, you had to fill out paperwork, but now, like, once that credit's filed, you don't have to keep like resubmitting every 10 years. It's an automatic approval for type 1 diabetics. There's the disability tax credit. And if you don't, like, and then the other one is like for your children. So I have one of my clients, her daughter was born deaf. So that disability credit tax credit rolls up to the parents. I have a couple clients that have adult children, so the disability tax credit can roll up to the parent. And roughly, it's about between $8,000 to $9,000 credit, which equates to about a $1,200 a year additional tax refund. And there's a bit of work. You have to file the paperwork and get the DT, it's called DTC, the disability tax credit. We got to get it approved, but once it's approved, it's ongoing, and you can go back as far as 10 years or to the date of first diagnosis. So I'm not going to go through all the things around credits, but number 3, it's surprising just the number of people that don't know what credits are available, including donations. There's a bunch, like digital subscriptions. I'll just name off a couple more just to not show how smart I am, but you're like, oh, that was so again, if you have a digital subscription to the Globe and Mail or the Toronto Star, those can be are deductible, or there's a credit there for them. Okay, number 4, this is, even if you're not there yet, it's good to know ahead of time. So number four is income splitting. So what happened? I do this for a number of my clients as well who are retired, and guess what? Sometimes it works out that, again, not to be stereotyped, but it kind of happens this way where often just the husband is working more than the wife because if she was off on like with kids in different times, so has more taxable retirement income, in which case pension income can be moved over on the tax return. So you don't have to tell the employer or anything. Just money comes out of the pension and it can be transferred on the tax return. Different than CPP. CPP can actually be split. And my parents did this. My dad was a retired teacher and my mom was a stay at home mom. So my dad had more, my mom didn't really have CPP. So you can actually submit an application into CPP to say, hey, I want some of the CPP transferred to my spouse so that it becomes taxable to the spouse and not to the first person. So it's really the strategy around income splitting. Now, even better if you're like, wow, I'm so far away from being retired. The other thing you can start to do is we go back to strategy one, which was RRSP. And I have this with a couple clients where we advise them to create and open a spousal RSP. Now the tax deduction comes to the spouse that's making the contribution, but the future income, the withdrawals are going over to the spouse. So that again, we want to get to a point at 65, it's much more favorable, and that's where different people are talking about revamping the tax act. It's much more favorable to have two people with 50 to 60,000 each, as opposed to one person with 120 and one person with like 15. The taxes don't equate out. So what we're trying to get is more equal. And a great way to do that is actually making contributions in advance to the spousal so that the withdrawals um, go to the spouse. Um, and the key there is just that with the spousal, it has to stay in the account for at least 2 years, and then a withdrawal after 2 years, it's taxable to the beneficiary. If it's done before that, it can be actually be pushed back to the person making the contribution. So it's not a way to, it's not like a 1 year thing. You can't do that. So anyway, hopefully that is enough of a high level just to get you scratching to either then go back to your financial advisor, person at the bank, or reach out to me. So let me just pause for 1 second here, just because some people had to go. And I'll message everyone that came back because everyone kind of registered today as a on the way in. And just let me do a quick thing to send this to everybody, not just to Paul. Value there. So there's my Calendly link. It's good for Mondays. Kind of making things so that I don't book calls like 5 days a week. But if you have to go or some point, you can just click on that and you can book a 15-minute. If you something came up and you're like, oh, that's really interesting, I'd love to have a further conversation, but it's a bit more personal. Then you can book a call with me and we can kind of hash that out after. Okay. All right, let's go back to the list. So we got through income splitting was number four. We're just past halfway through. The number five is kind of five and six kind of sound together, but number five is um, we're talking about leveraging capital gains, and probably a bunch of people show. If I talk about this, and people are like, "Oh, I've seen a lot about, heard a lot about this in the media recently." The lovely, the budget this year. Hey, we're gonna, only rich people have rental properties. The average little guy doesn't have rental properties, so we're just going to tax capital gains at 2/3 versus 50%, because it's only going to affect like the high net worth guys, and like the average little guy, none of those people have rental properties. Surprise, surprise. More Canadians than you think actually do have like a second property. Could be a condo that they owned originally and then they kept the condo. I have a couple clients that like kept their original house, renting it, and then they upgraded, and so their new house is the principal residence, but the second house is now a rental property, which is now subject to kind of the higher capital gains. Now there's a couple things there because there's a number of years where it's their principal residence. It's super important to work with an accountant if at one point they go to sell it, because there's a calculation to say there's a number of exempt tax years. Because literally have a client like this, they're out on the West End. They're not planning to sell, but up until like a year ago, that was a principal residence. So the first 10 years of owning that home is tax exempt because it was a principal residence. Only going forward, and then the gain going forward. So it's really important. I have a checklist of like 5 or 6 things, super important to do. I have a client right now, he just bought a new condo. He's going to rent his old condo. And I give him a checklist of like 5 things to make sure he does now, and not like trying to backtrack like 5 years later and trying to figure out what the values are. So capital gains, and this comes up subject, especially if you know someone has a family cottage. Most likely that family cottage is a second property subject to significant capital gains. Just as a quick example, I have a client where the mother passed away and he had it all set up. So on death, the properties all rolled over to him. Great. Worked with a lawyer, title all transferred over. Great. However, we have to do the final tax return like 2 years after death. Just got busy and had some illness and some challenges, just didn't get it filed. So we finally filed it, calculate out what the present value of the cottage is, adjusted cost base, blah, blah, blah. Yep, okay, he's good. There's like a $40,000 tax bill because of a deemed disposition. He's fine paying the $40,000, right? He's like, I understand, I'm gonna have to pay the $40,000, all good. However, goes back to point number 1, we're 2 years late filing it. So on top of the $40,000 bill, he got a $6,000 late filing plus interest bill. Ouch. Now, he does have an option, and I have a colleague, referral partner, who will help write a taxpayer relief letter and say, hey, due to being the complexity of being the executor and some other things, I just didn't, and health, I didn't really know what I was doing, and we filed it late. I'm okay paying it. He actually paid the tax bill. He's like, I'm just looking for some interest relief. So there is a good chance that he could actually get interest relief by writing a letter to kind of explain kind of why he was late. So my quick question to here, just to kind of say, because this is probably going to be a future topic in the next month or so around executor and estate planning. How many people in the room today are the executor of a will? Your loving sibling, your parents, someone that you love, they've tasked you with being an executor. Yeah, no, yes, yes, yes. So it's pretty cool because I was working on this tax return file today, and it was pretty neat because in it was there was actually some books from RBC Wealth. I'm like, hey, that's pretty cool. And a lot of financial advisors have these documents. I'm probably going to put this together and send a similar document like this out to my tax clients. And guess what? In the back of it is a checklist of all the things that an executor has to do. Are you aware of all the things you have to do as an executor? So let me just share, this is actually a bonus number 9. Actually, it wasn't on the thing, but this is a bonus number 9 for those people that said, yes, they're an executor. So guess what? One thing that you can do is you can actually go back and have an amendment to the will done to say that the fee that you can receive as the executor, which is up to 10% of the estate, you could have it so that's rewritten that that's kind of an extra segment as you as a beneficiary. So to say the 10% is 50,000. This happened with one of my clients. So there's 3 brothers. The one brother is the executor. So the executor fee was 40,000. What happened was that 40,000 was issued to him as a taxable income. Triggered $6,000 of CPP and a bunch of income tax. If the will had stated, hey, as for the fee for the service of being the executor, $40,000 will be as a beneficiary, non-taxable. Non-taxable. One of my clients, he just helped do a family friend, pretty complicated will, his executor fee was $150,000. He's a retired teacher. So on top of his teacher's pension, he's now going to pay, and he said, hey, how much do I, and the lawyer will actually run it through payroll and take off income tax. So he said, hey, guess what? Roughly take off income tax at 40%. So he's not going to get 150,000. He's going to get 60% of the 150,000, but he still did all the work as the executor. So there is a strategy where you can actually have that fee, or at least a portion of that fee, given as a as included as a beneficiary, as opposed to just a executor fee, because the executor fees are taxable, 100% taxable. So hopefully that's bonus number 9. Okay, so that we kind of touched really high on kind of the capital gains. There's some other strategies when it comes to capital gains. If you have investments, investments are sitting in not in your TFSA, not in your RSP, but if you have investments, stocks sitting in an open trading account, you can do what we call sell the losers in December. In which case, roughly by at least no later than the 5th last day of the year, sell off your losers, and it will trigger a capital loss. Now, if you still like the stock, you can buy it back after 30 days and buy it back at the lower price, but that will trigger a capital loss that can be used against capital gains or even past year gains. Your accountant can request and roll that capital gain backwards, or that capital loss backwards. So it's but that strategy only works if the stocks are sitting in a non-registered account, not your TFSA, not your RSP. Okay. So example, I have some I was looking to sell some bank stocks in my TFSA. It's because it doesn't trigger a tax event because it's sitting in a tax sheltered bucket. But if it's sitting in non-registered, sell the losers, trigger capital loss, apply it to capital gains. Okay, so that's the leveraging. Number 6 is invest in tax efficient investments. So this is, again, being aware of what products you're holding and where is it best to hold them in. For example, I'm not licensed. Let me just do the Tony Robbins. This is not financial advisor advice. Always seek your licensed professional to get specific advice, but this is just information. So, for example, bank stocks. Bank stocks are nice investments because they pay a really nice, a decent dividend, monthly, quarterly dividends. For example, one of mine, the stock that I hold, paying about a 6% dividend. Not bad, right? So that dividend, if I had that in a non-registered account, that dividend I would pay tax at 2/3. Dividends, eligible Canadian companies at 2/3. So I'm not, where interest income, employment income, taxed at 100%. So capital gains 50%, now 60% on property over 250,000, blah blah blah, whole bunch of things. Really, you need to talk to an accountant now for capital gains. Dividend income, your financial institution will issue you a T5, T3, will issue you tax slips, and the dividends taxed at a lower rate. So, but if your dividends stock is sitting in your RSP, guess what? No dividend break, because the dividend comes in and you pull it out as income. So even though it's producing dividends inside your RSP, it's all going to get taxed as income. So one option is hold it in your TFSA because it will grow. Those dividends will be non-taxable. So that's an option. Another option is to hold it in an open account because you're going to pay tax at 2/3. So it's really understanding kind of what additional investments, including insurance. Insurance can be an investment. Insurance can be, there's tax strategies for insurance because insurance isn't taxable. So there's all kinds of different things. One thing, investment, again, tax efficient investment strategies is really at a high level. Seg funds, segregated funds, they're set up as a beneficiary. So again, money can be passed on to the beneficiary through a seg fund, avoiding probate and just straight out. So again, if you have parents who are in their 70s, 80s, definitely in their 90s, it's probably a good idea to put, if they have investments, is to put some of that money into a seg fund because it can be 100% capital protected, but it can also be transferred to the beneficiary on death um, right away. Avoids going through the estate and avoids probate. Creditor protected as well. Yes, there's a bit higher fee with seg funds, but there's all like some super like tax benefit tax efficient strategies. And again, you want to talk to a licensed financial advisor to talk about that. So that's number 6. Number 7. Hey, we finally got here. We got 12 minutes to go. I'm actually doing okay on time today. It's pretty good. I haven't had I usually do that have someone like hold up a sign saying, "Hey, you got 20 minutes to go," just so we stay on time. Number 7. How many people are self-employed? Do a quick little survey. Self-employed. Anybody self-employed? Self-employed people. Yes, Christine is self-employed. Self-employed. Nope. Good. Not good. Just if you're not self-employed, that's great time. You're in the right spot. Paul is. Elizabeth, no. All right, and some other people. Yes, yes. Some other yeses and some no's. That's great. Okay, thanks. Just also make sure everyone's still awake. Haven't put people to sleep, or that your cat's. If you kind of went and got a sandwich and your cat's watching, your cat probably isn't self-employed, and your cat probably isn't tax deductible. There's different strategies about that, but anyway, I digress. Number 7 is deduct eligible business expenses. Now, this is always my favorite part. I still do a full presentation on maybe. Uh, uh, don't tell me from. It's not a service dog. Your cat's probably not a service cat, but anyway, I used to do a presentation just on number 7, the tax advantages of having a home-based business, or the tax advantage of being self-employed, the tax advantages of having a side hustle, the tax advantage of having something, a hobby, besides just your corporate job. So here's why I get passionate about this, and I'll get up on the front of my seat, and I'll get up and like jump around, do some jumping jacks here in a minute. But this is what gets me excited. Is for 20 years, for the first 20 years of my corporate career, I was just like everyone else. I was a corporate accountant. I didn't know anything about personal income tax. I filed my own tax returns. I didn't know. I just filed it, got a T4, RSPs. That's it. Maybe a little bit. My kids were in Montessori, so that's another tip. Tax credit, like daycare is tax deductible. Private schools can be tax deductible. So I did that for 20 years. I had no tax deductions. I was like you, the average Canadian paying 43% tax with like next to no tax deductions other than RSPs. And I was like, hey, what's that? What's the person next to me? Like, why are they? Maybe you know these people. It's like, why is that guy getting a new car? Like, why is that guy? How's that guy going on vacation? How is his kids like in sports? Like, where's this guy getting all the money? And it's one of two things. Either he loves debt, in which case the bank owns his house, the bank owns his cottage, the bank owns the RV, the bank owns the car, and it's just smoke and mirrors, or he's hustling in a good way, not like hustle and grind, but he's doing something to make everyday things tax deductible. My phone for 20 years, this thing was just a bill. Now I write this thing off because I have self-employment income. And the lovely thing about on the self-employed, it's called the T2125 on the tax return. It's for self-employed, small business owners, sole proprietors, income minus expenses, net income, taxes. If you're an employee like I was for 20 years, there's a thing called salary. And then there's a thing called payroll deductions, taxes, EI, CPP, all that stuff. And then there's a thing called take home pay. And we just talked about that. That Monday and Tuesday you worked for the first part, and now Wednesday, Thursday, Friday you're working for the take home pay. So when you're self-employed, the expenses get taken off before the tax calculation. And here's what happens with eligible business expenses: cell phone. And this isn't about having to earn money. The best part is I love working with clients who have a day job. because you're already paying 43% taxes. If in the first year, I just had a call with a potential new client. He's getting his real estate license. He's in a family business, so he's getting a T4 from the family business in Hamilton. He's become a realtor, and guess what? His realtor license, his brokerage fees, his car, his cell phone, all become tax deductible on the T2125. And if I trigger a business loss, that business loss can be applied to his T4 income tax paid. And we just increased his refund with expenses he was going to incur every day anyway. He's like, hey, when do I incorporate? Hey, we don't incorporate. This is like on the business expenses. It's kind of a bonus, kind of 7B. We don't incorporate until you're making money. We don't incorporate until your self-employment, your small business is making over $100,000. Don't incorporate. Yeah, oh, but someone said no. They don't know what they're talking about. No, maybe they do. Sometimes I say, hey, if your incremental growth is going to go like this, then yeah, then incorporate like now. If you're already earning like 200,000 and you're going to start generating income, yeah, you don't need more taxable income, and you have the income to support the corporate expenses. But if you quit your day job and you launch as a realtor tomorrow and you're going to do real estate 100%, my real estate clients, until they're making like 150 to 200,000 in a year in commissions, then we're opening a personal real estate corp, not before. The tax advantages on the other side by having those tax losses and just the marginal tax rate on a personal, because chances are you need to pull that money out of the corp to pay your living expenses, and then that triggers a whole bunch of other fun stuff. So that's it. So not to get into a whole thing, if you're curious, if you just want to put a note to say, hey, I'd love to attend that small, like the self-employed home-based business. So if you're curious to know like it's a whole different, it's like another 45-minute presentation to really go into the deep weeds of. So if you already are self-employed, or if you're curious about being self-employed or curious about having a home-based business, don't worry, it's not a bait and switch. I'm not going to sell you on Amway. I do have clients in Amway. So there is network marketing is a great example of a side hustle that you can do to make tax deductions. But if you're curious to know what those other expenses are and how to do it, including how to have your kids' tuition be tax deductible, then just type in home, and I'll plan to do it probably in the next 3 weeks. We'll launch that other monthly webinar on the tax advantage of having a home-based self-employment. And there's just more detail, and I don't want to get into it in 5 minutes because that wouldn't do it justice. But yeah, so for example, I pay my sons. My son does some work for me in my business. I pay him, and then he uses that money to pay tuition. My money to him, 100% tax deductible. He uses the money to pay tuition because the tuition tax receipt is only 16%. Hey, great to see you, Rob. Well, thanks for coming in. The tuition receipt is only 16%. So if I pay the $20,000, I'm only getting the 16% tax credit on the tuition. If I pay him the 20,000, the whole 20,000 becomes tax deductible to me, and then he uses the tuition, and then he gets the tax credit at 16%. But he can earn, your children can earn up to $15,000 tax free. Now, just be aware, Revenue Canada is clamping down a little bit on income splitting between families, so it has to be legitimate. I'm not paying my sons $15,000 at this point, but I'm paying him a bit to do data entry and some other work for me, so I'm paying him a reasonable amount. And but I have a client as a corporation, his kids, 2 university kids, and he just puts them on payroll for the summer, and that becomes a taxable deduction for his corporation for the summer. And those kids get the money. They pay tax at 50, marginal tax rate 15%, and much better than him at 40%. So yeah, that's it. Number 7, eligible business expenses, and then 7B was, and then at a certain point when your side hustle and your self-employment, you're kicking it and it's going really well, Then it's to have a conversation to say, hey, at what point do I incorporate? And that's it. So, all right, we didn't lose everybody. We're just still got 13 people around, which is beautiful. I appreciate you hanging in there for the full hour. Hopefully, you found like at least one thing. Maybe if you can you want, you can come on camera. If not, you can just type in into the comment kind of what was of the seven, I guess nine different things we eventually covered. What was the big aha? What was the one that you were like, oh, that's really good. I did not know that at all. Yeah, just curious to know what was the one that kind of hmm, I think I can use that one. Anyone? Anyone want to let me know? Uh, yeah,
Dwayne, I would
yeah.
say for me that it was when you were saying you would advise not to incorporate unless you're making over $100,000. That just stood out to me.
Hmm.
And then, of course, the whole idea of employing your child and using that as a tax advantage. So yeah, that was informative for me. And
Awesome.
lots more.
Yeah, no, I appreciate that. Thank you for joining today, Lynn. And it is kind of bright. Like again, it's not to like not broad brush because sometimes there's like a broad brush the other way. It's like, hey, everyone should incorporate because it's like the marginal tax rate of a corporation is only like between 12 and 15%. However, there's so as a quick bonus, as an example, just why it's so important to work with a tax professional. One of my clients registered as a corporation, and the risk is if you kind of quit your day job and your employer hires you back tomorrow on a corporation, there's a chance that you get deemed as a personal service business. And the issue with personal service businesses is a personal service business is not taxed as a small Canadian corp. It's taxed as a personal service business. And the personal service business tax rate's 43%. Ouchie. So example, I had a client that she earned about 80,000 in revenue. Now we're working to make sure that she is not a personal service business, but if she had to pay tax at 43%, she paid more tax on her corporation than she would if she just stayed as a T4. That's not great. So it's really important to, and again, there's some criteria as and how to make sure that you're not deemed a personal service business corporation. Um, and it generally means that you have more than one client. You can control your working hours. You assume a bit more of the risk. If you just kind of, like I said, if you're at a day job one day and you go back the next day and you're just invoicing them as a corporation instead of T4, chances are you're a personal service corp, and we don't want to we don't want that to be the case. So that's why it's really important to talk to an accountant if you're thinking about incorporating, just to make sure you got all the steps and the checklist done when it makes sense. So yeah, all right. So you said points 5, 6, and 7 sections are all good for me. Yeah, it's partially it could be on that. It just depends on where you are in your investment journey, on your earning journey, where you are and kind of age in life. There's some tips there for some younger people. There's some tips for people that are like moving towards retirement. There's a whole nother like a whole nother thing around CPP and like when to claim CPP and pensions and some other things. There's a whole nother strategy around another workshop type thing for when we're approaching retirement, things to consider before we retire. So this was really kind of a high level, kind of catch everything in one basket, and hope you found it helpful. I'm going to stop.